Hello, my name is Stacey Mankoff. I'm the managing principal of the Mankoff Company and found volume 3 of the Bellringer with Sully, where we're going to be discussing the future finance, crypto banking opportunities and challenges. Now, Luke is the CEO of Custody Digital Group, or CDG, and he's been working in this digital and blockchain space for quite a while now. Prior to working at CDG in 2018, lead for security for IBM, and that's one of the issues we're going to be touching on today. Luke has also had a lot of experience with other firms as well, and without further ado, I'd like to.
Hi, Stacey. How are you?
Hi, good. So anyway, one of the first questions to get into this is, how do you define a crypto bank?
Sure. So it's a crypto bank is a term that we actually use internally here at CDG, and what it does is it describes the global public blockchain networks and computing networks like Bitcoin and Ethereum that have this inbuilt functionality for people to be able to store and transfer value at very low rates and at very high speeds. And we use that definition. It's very helpful for us because when we're pursuing meaningful use cases and value propositions in the work that we do, we always pivot back to what a crypto bank is and what that inherent functionality is, and make sure that we're providing additive services around that and on top of that, and not trying to duplicate what is already there.
Okay. And so what are some of the advantages of it? And I mean, obviously with, and some of the disadvantages and what you're talking about, traditional banking, because as we had discussed before, when some people hear the word crypto, there are different intonations to that word.
Yes, that's a very polite way of describing it. I've heard some more crass words used about crypto when I've tried to explain it to folks. But ultimately, what these public networks provide for people is high-speed transactions at a low cost in real time, and they're not subject to some sort of censorship by an intermediary. And so it's the concept of programmable money, the programmable exchange of value across the internet, which I think is very exciting. It's very, very different to a traditional bank. It's light years away, and for a number of reasons. I think not least of which is the actual assets on these networks, are not interest bearing. So the ability to make deposits and generate interest, in crypto networks that's not an inherent use. And banks, the fundamental business model of banks as well is quite different. So they aggregate, they take deposits from people like ourselves, and then they look to take those deposits, aggregate it, and then generate opportunities to make money off of that. So so that's sort of primarily a bank's role, and how they make money. So it's very, very different to this sort of core fundamental principle of these public network tokens. And for us at CDG, we looked at that problem set. We wanted to, provide additive services, and we looked at where the market was. And what we saw was, as a crypto wallet is to, an individual. So having your own wallet on an exchange that holds public network tokens, for us, having a controls environment that allows you to manage increasingly complex portfolios of digital assets, that's really where we felt that there was a real growing need, and the market was still very underserved for clients in the enterprise and institutional space that wanted to interact with these networks, but wanted to do so safely, and wanted to have retain their privacy and be able to build out these complicated and complex portfolios across a variety of different asset classes.
Okay. Um, when you're talking about this, one of the biggest issues, some of the biggest issues are threats to that sort of, anti-fraud, money laundering and things of that. How are you handling those type of issues as well?
Yeah, it's a really good it's a really good question.
Security is really, with
Yeah,
banks itself, security is key. And, you know, as someone whose bank account has been hacked, that's something that people are really looking at as well.
yeah, it is. I agree, and I think we see you've seen a lot of instances in the past 10, 20 years where banks take unilateral action over people's deposits, and there's this sense that just because you make a deposit into a bank, it's not insured up to 100% of what you have, and that there are a number of hacks that can take place at banks, and usually those are centered around the impersonation of people's identities, or accessing personal identities as well. And for us, those are challenges, and crypto has been subject to hacking, and there has been theft of digital assets, and those have mostly been targeted at exchanges as well. So as we sort of built out our own controls platform, we did a few things differently. So we have, if you look at a lot of the security mechanisms for managing transactions in Bitcoin, predominantly, they use signature schemes called, something called a multi-signature scheme, where you can separate various parts of the private key amongst various participants. But for us, we've abstracted the governance of the asset away from the private key itself. So there's an abstraction layer of many layers of encryption before anyone can access and treat the private key for the asset. So for example, in a custody situation, if you're an institution, you're holding 10, 20, $50 million worth of Bitcoin. You want to be able to make sure that the asset key that actually holds that value is stored very safely, but also that the treatment of the asset is separated away. So that governance layer is something that we've worked on, and we've tried to create a very transparent way of being able to manage these portfolios. So for example, if you have multiple signatories on an account, you set up an account, you have 10, 20 million, you'll probably need at least one person to sign off on any movement of that asset. And particularly you'll have thresholds, velocity thresholds, or dollar amount thresholds from which you need additional signatures. And so we've created a mechanism to do that with full transparency. So we know exactly who is signing off on a transaction at a particular time. And that signature aggregation model is one of our sort of one of our value prop, our differentiators, and that allows us to not only separate away the asset from the governance, but also it's not it's what we call chain agnostic. So the security mechanisms are not reliant on the actual individual blockchain itself, which means we can do the same. We can apply the same security standards across any type of asset on any type of blockchain.
Mm-hmm. What is the biggest pushback you're getting from the institutions on this? Because it sounds to me like it's very secure. It sounds more secure than what my current banking system is. And I'm sure institutions could look at that and say, "Why? We wish we could transpose that into, the traditional model." So, what is it? What is that why isn't everybody adopting this?
It's a good question. Like I think. I think if you look at banking legacy systems, they're extremely complicated, and they are there are layers and layers of IT infrastructure there that's very difficult to adapt and change. And so they're quite cumbersome in terms of how they're structured. And as somebody who worked on, particularly in cryptographic services for banks when I was at IBM, I've seen firsthand, some of the challenges there. I think for us, what we hear is, given part of our system is custody, and so which is the safeguarding and administering of assets on behalf of third parties. So in high volumes, we hear a lot that custody is custody is a commodity service, and the price is going to be driven down to zero. There are more valuable services out there in the market, and I have to say, I agree to it. I agree with it to a certain point, but not entirely. I think if you're acting as a custodian, you are essentially taking a lot of risk, operational risk, and you're managing risk for your client, and therefore that comes with it a price. And so I don't see how a relatively high risk service should be priced at zero. We just don't agree with that. Now, within custody, if you're talking about the storage of assets,
right?
Well, that's again, custody is both the safeguarding and the administering of assets. If you talk about safeguarding or the storage of assets, well, that is a commodity service, and there are a number of different ways you can store assets. You can write them down on a bit of paper, put them in the vaults. You can hold them on a USB key offline. You can use a WYSI new encryption technology called MPC. Now, those are commodity services, and so we think that the storage of assets will be driven to zero, or there will certainly be a lot of downward pricing pressure on there. But the administering of those assets in the custodial environment, shouldn't do that. So that's sort of our biggest pushback, I think. And I think custody, it sort of gets lost in the discussion around storing assets. And actually, if you look at what custody is versus what storage of assets are, they're actually quite different. And that's sort of the differentiation we're trying to explain to folks in the market. And that's, I think, part of our success so far in being able to do that.
And what about in regards to regulation? Do you see any governance regulation? Do you see any effect effect in different parts of the world? Is it accepted more in some areas more than others, and breaking into other areas? Are there different challenges?
Yeah, there are, and not all jurisdictions are regulating the industry in the same way at the same time. So there are sort of multi-speed regulatory regimes around the world. If you were to be really cynical about this, you could say that the regulatory licenses that are being established are really to protect incumbents and to manage out the smaller players by virtue of the obligations, the regulatory obligations they have. I don't necessarily.
Nothing really new, is that?
Yeah, and to a certain degree, I think most. I haven't spoken to every regulator out there, but I have had quite a lot of exposure to regulators in the past, and they're very accepting of innovation, and they realise the fine balance they've got to strike between promoting and encouraging innovation without stifling it, but making sure that they can protect consumers, and they can protect and that they can enforce their processes on companies that are behaving badly. So I think there's a big difference in the US and the EU, where we kind of have a foot in both, but we're primarily EU focused. I think a lot of the regulation that we're seeing coming from the EU level will come down via the fifth anti-money laundering directive, primarily, and that will filter down from the EU to be taken up and interpreted by each nation state. But custody is custody in the US is you have to be registered as a trust or a bank.
Yes.
and that sort of hasn't really changed unless you're in New York. And there's some additional licensing requirements there. I think the challenge in the US particularly is around the reciprocity of activities from a state by state basis. So, I think casual observers of the US assume it's all one regime, but obviously, as you know, it's on a state by state basis. And there were a lot of crypto companies in general set up in states that had sort of low to no regulatory licensing regimes in order just to get themselves started. But you have to have at a state level, you have to have reciprocity with other states if you want to go and do business there. And New York took the view that they didn't really want to offer any inbound reciprocity from other states. But if you were to be licensed primarily in New York, then you could have outbound reciprocity across the US. And that sort of, I think, generally is the general guiding principle of where you want to operate in the US. But again, I'm neither a lawyer, a regulator, or nor do we operate in the US. So I'm still more of a casual observer. But yeah, I think we are seeing a number of business models take off that fundamentally we believe should be regulated and aren't. And I think the delta that we're seeing right now is useful for innovation, but by the same time it does push the boundary of risk. And I think folks who are entering into this industry need to be super careful about what businesses they're working with and who's got access to their assets and where they're looking to generate reasonable returns from.
Mm-hmm. Well, is there anything more you would like to add? I'd also like to get your vision. Let's say, where do you see this marketplace, next year, 5 years, 10 years? Are we just in the beginnings of this, or is, how is this going to mature?
Yeah, we for the last, almost 8 years, I've heard that we're at the beginning.
Yeah.
And I still believe we are.
Uh-huh.
I think sort of time will tell as to how the industry will mature and evolve. I'd like to think that there will be, that particularly this year and the impact that this year has had on small businesses and innovation writ large. But I'd like to think that there will be a better, stronger use cases that digital assets can supply that have a real world application. Right now, what we're seeing is very isolated and insular use cases that don't necessarily have much correlation or relationship with real world finance. And so that intersection with the real world and digital assets, I think, is the really exciting part. So that's the space that we're looking to play in terms of how our product marketplace evolves as well. We're being very selective about the products and services that we offer. And we're also looking and have built our own proprietary instruments as well, which we're looking to refine and deploy as well. So what we're really, I think the vision here is to help people generate revenue safely and to provide a sort of a one-stop shop opportunity for folks to manage complex digital assets and be able to be exposed to them by virtue of our platform, but do so safely, and in doing so be able to generate revenue for themselves and for their stakeholders using use cases which have a real world application. That would be great.
Mm-hmm. Well, I'd like to thank you, Luke, for participating in this Bellringer, and I hope to work with you again and see what developments are happening with CDG. Thank you so much.
Thanks very much, Stacey.
Bye-bye. Okay, bye-bye.